Hi everybody, welcome to my YouTube channel. For those that don't know me, my name is Chi. This channel generally focuses on finance, some YouTube tips and some lifestyle advice thrown in for good measure. This video is going to focus on my view in terms of whether we're going through a V-shaped economic recovery, what happened in the month of June 2020, and also my view in terms of what to look out for the current month, which is July 2020. If that sounds of interest to you, then stay tuned. But before we go any further, do hit the subscribe button and the notification bell so that you can get an alert each time I upload a new video. So let's get into it. June 2020 was a very strong month for equities. At the beginning of the year, we had very strong equity markets, and then we had a bit of a collapse, which ended in a low point on March 23rd. Since March 23rd, markets have been up nearly 20%. The definition of a V-shaped recovery is where you have a very sharp drop and you have a very sharp acceleration. When we're looking at financial markets or investing in general, there has to be a period with which you look at your investments and you compare it to another period in time. Typically, this tends to be on a monthly basis and a quarterly basis, but you also have two halves of a year. So that's why June 30th of any particular year is actually quite an important date, because it's the end of the month of June, it's the end of the second quarter of the year, but it's also the end of the first half of the year. If you've been following financial markets, you would have heard a lot of things like, oh, it's been the best quarter, for example, for the S&P since 1989. In European markets, for example, if you looked at the German DAX, it's been its best quarter for the last 5 years. And that's been quite a shock. That's been quite a shock to a lot of market participants, because there has been a lot going on in terms of bad news in the markets, in terms of the health crisis that we're currently going through, even the economic crisis in terms of across the world, a slowing down of economic data. Financial markets operate on confidence and perception, and also valuations in terms of the companies that make up a lot of these indices, as well as future expectations. We had a slowing down of economies across the world, where a lot of countries went into lockdown and you had a sharp deceleration of economic activity. And then what you had was governments across the world in various countries pumping money back into the economy, so taking fiscal measures. So that's where the government steps in and, for example, hands money directly to the population, as we saw in America or in Europe, where we saw the government stepping in to help companies pay furloughed staff, giving loans to small businesses. These are what we call fiscal measures, and a lot of this was done in a very short space of time. So that meant that the sharp shock to the economy could be somewhat mitigated by some of this money being pumped back into the economy. You also had central banks around the world take various measures to be able to give the market confidence, and that's the key thing. The reality of what's happened is that there has been a shock to the global economy, but the market works on expectations and it works on confidence. And as long as it can feel that if things got worse, for example, there'll be some help, whether it's in the form of central banks or governments, then it can look past that. It can look through the immediate issue of the short, sharp shock to the economy. And that's basically what's happened here. In the US, you've got the Federal Reserve, which is the central bank there, coming in significantly, just sending a message to the market that it will do whatever it takes to prevent it falling into a tailspin. And that is all the market needs. You've also got a situation where a lot of people are working from home now. So you've got companies like Zoom, Apple, Microsoft, Facebook. You've got these companies which have done phenomenally well, where a lot of companies, a lot of people are starting to realize that you don't necessarily need to take a plane to go somewhere. You can still have a conference call on Zoom, for example. You're having indices being driven by a lot of tech companies. They are literally powering the rally and the rise in prices that we're seeing. So those are the reasons why we have seen such strong performance. We have seen extraordinary fiscal as well as monetary policy measures. We've seen a rally that's really being driven by a small number of stocks. We've seen the market look and say, well, actually, yeah, things might have been bad, but at the end of the day, we can rely on central banks around the world to come in and shore up the confidence needed for this market to operate in the way that it's currently doing at the moment. And then you've also had an easing of the lockdown measures, especially in the US. The market has looked at economic data in the US, which has come a lot stronger than expected, and also in Europe, where we've seen manufacturing data that's also been coming out a bit stronger than expected. Generally speaking, The expectation is that this is going to be a very short recession, maybe one of the shortest recessions in history, and that even though there may be bumps in the road ahead, we're going to get through this period and come out on the other side much stronger. That's what the market is expecting. That's why the market is behaving in the way that it is doing, and that's why we've had such a strong quarter. That's why we had such a strong June. My personal view is that I think the market has come too far too soon. I am a bit concerned about how the market is totally discounting the possibility of a second wave. The other issue is that an economy cannot just rely on help from central banks as well as fiscal measures taken by governments. An economy has to stand on its own 2 feet. Now, what we had there was a situation where economies were literally turned off to zero. So I would fully expect in the immediate aftermath of those taps being turned back on that the data would be stronger, because people are now going back to work. And what's going to be important is how the recovery stands the test of time. So in the coming months, let's just say in the next 2 quarters, what we see. I think the market is pricing in perfection. I think the market is pricing in no second wave, a vaccine before the end of the year, no issues whatsoever. And I think that's a little bit risky. So my view would be that, okay, yes, fine. A lot more has been done than I was expecting by central banks around the world. And that has provided a boost to the economy. So I expect the recovery to be maybe a bit quicker than I had initially thought. But I do think that there are going to be bumps in the road, and I think the market has completely discounted that. So I think that there could be volatility ahead. In terms of what I'm going to be looking at, Brexit will be a key factor. And one of the points I made in that video was that the deadline for possible extension, if talks do not go well, was 30th of June 2020. That deadline has now passed. So it means that the clock is ticking. It means that by December the 31st, if there is no deal, they haven't managed to iron out the finer details, then the UK will be leaving with no deal, or on terms that the market isn't currently expecting at the moment. And as we approach that day, we could see if the talks don't go as well as expected, we could see some volatility in UK assets, particularly the pound sterling, as well as UK equities. So I'll be keeping an eye on that in the month of July. And I'll also be looking at the US presidential elections. Just generally speaking, the market perceives Donald Trump to be very good for the economy and the Democrats not so much. So as time goes on and we start to focus more on the elections in the US in November, we'll start to see the market will start to price in more in terms of the expectation of what that result could be. So those will be the 2 things I'll be looking at. I'll also be looking at US in terms of the data coming out, whether they're having to roll back, opening up so quickly. I'll be looking at companies like Apple if they're closing more stores, and also paying attention to the data out of China, as well as what's going on in Europe in terms of how well their easing of lockdown measures is going. That's my view. I think the market has come too fast, too soon. I expect some volatility ahead. In terms of how I'm positioned, my pension portfolio is long equity, so that has done very well since the end of March, and it has recovered all its losses that it saw in Q1 and some. And then in terms of my trading portfolio, I'm short the market, which has been very difficult, and I will just continue to monitor my positions. I hope you've enjoyed the video. If you're an investor, do drop me a comment. Let me know what you're thinking. Have you been able to take advantage of the strong rally that we've seen in equity markets? If you're not an investor, are you thinking of becoming one? Is there anything that's holding you back? Is there anything that you'd like to know more of? Are you thinking of going into a particular area? If you like the video, do give me a thumbs up, and if you haven't already, do hit the subscribe button and the notification bell so that you can get an alert each time I upload a new video. Thank you very much for watching. Take care for now. Goodbye.